Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. This week up, we're going to look at Peloton. I've had a lot of requests for this stock. Let's take a look and see how much cash money they make. They're trying to do a turnaround. The stock's down almost 90% from the peak. It's now below pre-pandemic levels. Let's figure out how much cash money this stock makes. And if we like it, we're going to buy it. Ready? Let's get to work. Okay, the first thing we want to do is we want to take a look at their 10K. So I'm going to bring up the 10K, which is behind me, Peloton Interactive. We're going to pull up the income statement, or let's pull up the balance sheet first. It's right here. And we're going to take a look and figure out what their financial position is. Now, this is March 2022. Their fiscal year ends in June, so their fiscal year isn't even over yet as a result, as of filming of this episode. So we're not going to get their annual report for another 3 months. So the first thing we're going to do is we're going to go to balance sheet, and we're going to pull the most recent quarterly statements because that has the most accurate balance sheet. Remember, a balance sheet is a point-in-time measure. Income statement, cash flow are over time. So a balance sheet, you always want the most current balance sheet you can use. Income statement, cash flow, you want to use those over time. So let's dive through this. This is Peloton's March 22 balance sheet. Cash equivalent, $900 million, down from $1.1 billion earlier. They got a ton of inventory, which they've commented they're having to write down it. They're having a hard time selling it. It is selling, but it's very expensive, and it's a cash drain from them because it's tied up in there. Equipment, very weak, very little actual fixed assets. Liabilities, $716 billion of accounts payable. Billion, I said million, $716 million of accounts payable. The problem here is this is all due within 1 year, 716. That's why it's a current liability. The cash to pay it they have is $900 million. So that's going to barely pay the bills they have coming due, not to mention debt service like interest or other operating losses if they continue to lose money. So I go down, they got some other liabilities, not too huge. Convertible security note, $855 million. That's a big one. And then operating leases, $736 million. Not really come due. That's in the operating expense in the P&L. But the big thing here for me is this liability that's going to come due and the cash they have on hand to pay it. Let's take a look at the income statement. Income statement here, 3 months here, 9 months here. I'm going to focus on 9 months because it gives me the longest time period to help measure the business if I don't have annual numbers. Okay, so $2.9 billion is what they made in total revenue, about 50-50 between subscription and fitness products. That's down slightly from the prior period, right? So their revenue's decreasing. Cost of revenue is slightly less than the revenue they generate. So they have a very, very weak gross margin. $700 million on $3 billion is too small for a manufacturing company. It should be 50% or higher. Operating expenses, $860 million on advertising. That's going to go when they have to turn that company around. That's a huge number. $731 million in general admin. That's way, 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 way too high. They have to cut that massively. Research and development, again, that's going to go, but that could slow their product development. That's $250 million, $274 million. Whew. And they got some write-downs from bad investments that they made, and they lost. They lost $1.5 billion. So now the problem is, if they're losing money currently, they're running forward at a losing rate. They've got bills coming due of $700 million. They've got $900 million of cash. What are they going to do? They need more capital. That's clearly here. If you read the statement from the CFO, the new CEO, there's also a new CFO. If you read their statement, their investor letter, they have already signed an agreement to borrow money from JP Morgan and Goldman Sachs, which is just a bridge loan essentially to get them to turn the business around. If that fails, they're going to have way too much debt on their balance sheets. They're either going to have to do a massive stock issuance or file for bankruptcy. One of the two if their plan fails. So it's a big, big gamble here. Let's take a look at cash flow statement. My favorite statement, your favorite statement, cash flow. So this is 9 months, 2022 of cash flow. $1.6 billion of jack that they're just burning up in the air. That's crazy. $1.6 billion. A lot of that is, and that's with adding back, by the way, $250 million of stock-based comp. So if you expense this add 250 on top of that, you're close to $2 billion of cash that they burned last year. Let's just check revenue. Not 9 months, not a year, 9 months. Let's check revenue. Revenue is $3 billion. They burned in cash $2 billion on an adjusted basis. They're almost better off just simply not operating. They'd make more money just doing nothing than operating. That's quite remarkable. Good job, guys. That's a great feat for you. Let's take a look and see what their historical operations have done. Revenue, growth, obviously, that's what everyone focuses on. Revenue, great. But how much cash do they actually make, right? EBITDA is a loss. Enterprise value, EBITDA is losing money. In terms of debt, they've got a giant note here. That's going to balloon up another $900 million when they borrow that more money. Market cap, enterprise value, it is what it is. But you've got this giant zone here that when I try to look at 9 years of historical financials, it's just nothingness. So I can't tell how they operate historically. I can't tell if there's some funky accounting going on, and you can only fake that stuff for so long. If you look at 9 years of data, it's going to show up someplace. So I can't tell, not that anything is wrong, but I just can't tell, and there's this ambiguity for me is way too much. If I look at cash flow itself, adjusted cash flow, CFO, for the fiscal years historically, last year, fiscal year, $434 million. This is adjusted free cash flow, so minus share-based comp. This next year here is going to be almost $2 billion. I think that's what I said earlier, if not more. That was 9 months. You got another quarter to add on to that, another 3 months. So that's going to be a massive, massive loss for them. CapEx is pretty big relative to free cash flow because it's zero. Debt payments, they borrow, they're going to have to start paying that back. This is not a great story. And you got a lot of missing data here for an ability to forecast. So for me, if I were to look at this business, I think it's a pass. I'm going to give it a bad. I'm going to give it a bad because there's no historical financials. Revenue is not growing, it's declining. EBITDA is negative. Free cash flow is negative. And forecast, I'm not forecasting the business. It's such a gamble to figure out where this thing is going to go. Who knows what's going to happen? I would wait it out, see what happens. I do like turnarounds if they get some traction, if they can turn around revenue. They've got $800 million of told savings that they can cut. Good for them. But they have to cut that over a 2-year period of time. And in the meantime, they're burning cash. They need to float themselves that period of time to produce the savings. So there's a lot of balls in the air. I would stay away from the stock until you get a little more clarity. Check out my website, cashflowinvestingpro.com. On that, I teach a course on how to become a financial analyst, a cash flow course, where I give you this Excel template, I give you the Apple 10Ks, and you and I walk through with slides, 3 hours of content where I explain how I get all these numbers in the 10K, what they mean, how to build a forecast, what market multiples mean, and how you can build a portfolio for yourself with forecasts that you've built and understand what you're buying rather than just reading a random report. Definitely check that out, cashflowinvestingpro.com. Look for the cash flow course. If that's too much work, combing through 10Ks, do all the work yourself, but you like the style of what I'm doing, I do publish one-pagers. It's a cash flow club one-pager in the upper left-hand corner when you're on my website. Join it. It's $15 a month, but I kick out a whole lot more cash flow club one-pagers than I can do YouTube videos. So in here, there are a lot of, this is Intel, this is Target, I've done Netflix, I've done those as well as others that are yielding 20% projected IRRs. I mean, this down market is the time to be a cash flow analyst and a single picker. Please check it out. I put a lot of stuff out there. There's some very interesting retail stocks now, low names that you don't normally go to, but are projected to do very, very well. Definitely check that out. You can also, in the description below, check out a link to a free one-pager on my website so you can get a feel for the style of the one-pager. It's got 10 years of historical financials in it. I summarize the 5 key attributes. I give you the forecast, the IRR calculation, notes, and a chart on the stock. It's very, very popular. Please check it out. All right, this has been a really quick Peloton review. Check out the other videos coming up. Let me know what else you'd like to see. I'm happy to do the reviews. Thank you very much. Bye-bye.